Hello, and welcome back to Boni's Life, your home for navigating the wild, wonderful, and sometimes utterly bewildering world of crypto. If you've been watching the charts lately, you might be feeling a bit like you're on a roller coaster that's lost its brakes. One minute you're soaring, the next you're plunging, and all you can do is hold on tight and try not to spill your coffee. Well, today we're going to grab the schematics for that roller coaster. We're going to understand its every twist and turn. And by the end of this, you'll be the one who knows when to put your hands up and scream for joy and when to brace for impact. We're diving deep into the current state of the crypto market. And I mean deep. We'll be looking at this from every angle. Whether you're a short-term trader trying to scalp a quick profit, a midterm investor looking to ride the next big wave, or a long-term hodler with diamond hands and nerves of steel. We'll dissect the technicals, scrutinize the fundamentals, and even peek into the minds of the whales. So grab your notebooks and let's get to work. First, let's zoom out and take a look at the entire crypto landscape. As of our recording on November 18th, 2025, the total cryptocurrency market capitalization is sitting at a hefty $3.19 trillion. Now that's a number big enough to make even a seasoned Wall Street veteran's eyes water. However, it's the short-term movement that's causing a stir. We've seen a 4.1% increase in the last 24 hours, which on the surface looks bullish. But, and this is a big but, this comes after a brutal 6-week period that has wiped over $1.2 trillion off the market's value. Bitcoin, our beloved king of crypto, has tumbled nearly 30% from its all-time high of over $126,000 in October, briefly dipping below the psychologically critical $90,000 mark. For many, this has erased all the gains of 2025, a sobering thought for anyone who jumped in during the recent euphoria. So, what's causing this market-wide anxiety? It's a cocktail of factors, a perfect storm of macroeconomic headwinds and internal market dynamics. The biggest ghost at this feast is the uncertainty surrounding the US Federal Reserve's next move. The market is currently pricing in a 50-50 chance of an interest rate cut in December. Think of it as a coin toss, but with trillions of dollars at stake. A rate cut would typically be a bullish signal for risk assets like crypto, as it makes borrowing cheaper and encourages investment, but the Fed is caught between a rock and a hard place, trying to tame inflation without derailing the economy. This indecision is creating a risk-averse mood across all financial markets, and crypto is feeling the chill. But it's not just the Fed. We're also seeing significant selling pressure from within the crypto market itself. The October flash crash, which saw a staggering $19 billion in leverage positions liquidated, has left a deep scar on the market psyche. Many retail buyers were burned and are now understandably hesitant to jump back in. This has created a vacuum on the buy side, meaning there are fewer buyers to absorb the selling pressure. And who's selling? We're seeing institutions and even some publicly traded companies who had been enthusiastically stockpiling crypto now unwinding their positions. Standard Chartered has estimated that with Bitcoin below $90,000, about half of the Bitcoin held by these public companies is now underwater, meaning they are holding it at a loss. This is a dangerous situation, as it could trigger further selling if these companies decide to cut their losses. Now, it's not all doom and gloom. Amidst this sea of red, there are some glimmers of hope. Institutional adoption, the holy grail for long-term crypto bulls, continues to march forward. Harvard University, for example, recently increased its stake in a Bitcoin ETF by a whopping 257%, making it their largest single holding. This is a powerful vote of confidence from one of the world's most respected financial institutions. And let's not forget the Bitcoin ETFs themselves, which have amassed over $65 billion in assets under management since their launch. This tells us that while the short-term sentiment may be bearish, the long-term institutional thesis for crypto remains very much intact. So that's the lay of the land, a market caught in a tug-of-war between short-term fear and long-term faith. Now, let's put on our trader hats and see how we can navigate this complex environment. Alright, for all you short-term traders out there, the ones who live and breathe by the 1-hour and 4-hour charts, this current market is a double-edged sword. On one hand, the volatility is a scalper's dream. On the other, the lack of a clear trend can lead to a lot of frustrating fake outs. So let's break it down. Looking at the 4-hour chart for Bitcoin, we're seeing a classic case of sideways consolidation after a major drop. The price is currently trading in a range between roughly $93,600 and $100,000. This $93,600 level is absolutely critical. It's the 0.618 Fibonacci retracement level, a mathematical point of support that often acts as a turning point. A break below this level on high volume would be a very bearish signal, likely opening the door to a further drop towards the $85,000 to $86,000 region. Conversely, if we see a strong bounce off this level, it could signal a short-term bottom is in. For the scalpers, the strategy here is to play the range. Look for opportunities to go long at the bottom of the range, around $93,600, with a tight stop loss just below your target would be the top of the range, around $99,500 to $100,000. Conversely, you could look to short the top of the range, with a stop loss just above $100,000 and a target of $93,600. However, beyond, this is a high-risk strategy. The market is currently in a state of extreme fear, with the fear and greed index at a chilling 12. This means that any piece of bad news could trigger a cascade of selling, and you don't want to be caught on the wrong side of that. Let's look at our indicators. The 4-hour RSI is currently hovering around 41.23, which is in neutral territory. This tells us that the market is neither overbought nor oversold, which reinforces the idea of a sideways chop. The MACD, another momentum indicator, is also showing a lack of a clear trend, with the MACD line and the signal line intertwined. This is not the time for bold directional bets. This is the time for patience and precision. One interesting metric to watch is the open interest. We're seeing a slight increase in open interest, which is currently at $140.71 billion. This means that new money is coming into the market, which could be a sign that a bigger move is brewing. However, the 24-hour long-short ratio is at 47.76%/52.24%, which shows a slight bias towards the short side. This tells us that the market is still leaning bearish, and any rallies are likely to be met with selling pressure. So, for the short-term trader, the key is to be nimble. Don't get married to a position. Take your profits when you have them, and don't be afraid to cut your losses quickly. The big money in this market will be made by waiting for a clear break of the range, either to the upside or the downside. Until then, it's a game of inches. Now, for our midterm traders, those of you who are looking at the daily and weekly charts, the picture is a bit more complex. You're not just trying to catch a quick scalp, you're trying to identify the next major trend. And right now, the trend is undeniably bearish. On the daily chart, we have a completed shoulder-over-shoulder pattern, a classic bearish reversal pattern. The head of the pattern was formed at the peak of around $124,000, with the shoulders in the $112,000 to $114,000 range. The neckline, the critical support level for this pattern, was at $105,500 to $106,500. We have decisively broken below this neckline, and more importantly, we have retested it from below and been rejected. This is a very strong bearish confirmation. The theoretical target for this pattern is a drop to the $85,000 to $86,000 region. This level also coincides with the 0.786 Fibonacci retracement level, making it a very strong confluence of support. This is the level that midterm traders should be watching very closely. A bounce from this level could signal the end of the correction and the beginning of a new bullish wave. However, a break below this level would be catastrophic, likely leading to a much deeper bear market. Our moving averages are also painting a grim picture. The 8-day EMA is trading below the 21-day EMA, and both are sloping downwards. The price is trading well below both of these short-term averages, as well as the 3-month EMA, which is all the way up at $110,000. On the weekly chart, we've had a negative crossover of the 8 and 21-week EMAs for a month now. All of this points to a sustained period of selling pressure. So, what's the play for the midterm trader? The most prudent strategy right now is to be patient. The time to be aggressively long was during the rally. Now is the time to be cautious. If you are not already in a short position, it might be too late to chase the price down here. Instead, the smart move is to wait for a clear signal that the bottom isn't. This could be a strong bounce off the 85,000 to 86,000 support level, accompanied by a bullish crossover on the daily MACD and a move out of the oversold territory on the daily stochastic RSI. Another strategy is to look for opportunities to short any rallies. The $99,500 to $100,000 level, which is the top of our short-term range, is now a significant resistance level. A rally to this level that is met with strong selling pressure could be a good opportunity to enter a short position with a target of the $93,600 support level and then potentially the $85,000 to $86,000 level. It's also important to keep an eye on the fundamental picture. The uncertainty around the Fed's interest rate decision is a major headwind for the market. A surprise rate cut in December could trigger a sharp rally, while a decision to hold rates steady could lead to another leg down. As a midterm trader, you need to be aware of these macroeconomic factors and how they can impact your trades. And now, for the long-term investors, the hodlers, the true believers, for you, the day-to-day price fluctuations are just noise. You're not concerned with the 4-hour chart or even the daily chart. You're looking at the multi-year cycles, the fundamental drivers of adoption, and the long-term vision of a decentralized future. And from that perspective, the current market correction is not a reason to panic, but an opportunity to accumulate. Let's talk about the Bitcoin halving cycle. Historically, Bitcoin's price has moved in 4-year cycles, driven by the halving event, where the reward for mining new Bitcoin is cut in half. This creates a supply shock, which has historically led to a massive bull run in the year following the halving. The last halving was in April 2024, which means that 2025 should be the year of the bull run. However, the recent price action has led some to question whether the 4-year cycle is still relevant. The rise of Bitcoin ETFs and the influx of institutional capital have fundamentally changed the market structure. Some analysts, like the CEO of Bitwise, have suggested that 2025 may be the last year of the typical 4-year cycle, and that the market will become more driven by institutional flows and less by the halving cycle. This is a fascinating debate, and one that will have profound implications for the future of crypto. But regardless of whether the 4-year cycle holds, the long-term fundamental picture for crypto remains incredibly strong. The institutional adoption that we've been talking about for years is no longer a distant dream. It's a reality. We have major universities, pension funds, and even sovereign wealth funds now investing in crypto. This is a massive shift, and it's providing a level of legitimacy and stability to the market that we've never seen before. Regulation is another key long-term factor. While the short-term uncertainty around regulation can cause volatility, the long-term trend is towards greater clarity and a more mature regulatory framework. In the US, we're seeing a bipartisan effort to create a clear set of rules for the crypto industry, which will ultimately be a good thing for the market. It will provide a level of certainty that will encourage even more institutional investment. So for the long-term investor, the strategy is simple. HODL. The current market correction is a test of your conviction. It's a reminder that crypto is still a volatile asset class and that the path to mass adoption will not be a straight line. But if you believe in the long-term vision of a decentralized future, then this is not the time to sell. This is the time to be patient, to accumulate, and to remember that the best is yet to come. Before we dive into our trading strategies, let's talk about some of the less glamorous but critically important metrics. Volume, liquidations, and market depth. These are the metrics that separate the amateurs from the professionals. First, let's talk about volume. The 24-hour trading volume across all cryptocurrencies is currently sitting at $250.414 billion. Now, that's a big number. But what's more important is the trend. We've seen volume increase significantly during the recent sell-off, which tells us that this is not just a few weak hands selling. This is institutional money moving out of the market. When you see high volume on a down move, it's a sign that the selling pressure is real and sustained. Conversely, if we see a rally on low volume, it's likely to be a dead cat bounce, a temporary relief rally that will ultimately fail. Now let's talk about liquidations. In the last 24 hours, we've seen $797.69 million in liquidations. This is down slightly from previous days, but it's still a significant number. The majority of these liquidations have been on the long side, which tells us that a lot of traders were caught betting on a rally that never came. The top liquidations have been in Bitcoin, with $14.54 million, followed by Ethereum with $11.19 million, and Solana with $1.08 million. These liquidations are a sign of the high leverage that exists in the crypto market. When the market moves against you and you're leveraged, you can be wiped out very quickly. This is why risk management is so critical. Another important metric is open interest. As we mentioned earlier, open interest is currently at $140.71 billion, which is up 0.52% in the last 24 hours. Open interest represents the total number of outstanding derivative contracts, such as futures and options. An increase in open interest can signal that new money is coming into the market, which could be a precursor to a big move. However, it's important to look at open interest in conjunction with price. If open interest is increasing while the price is falling, it's a sign that shorts are piling on, which could lead to a short squeeze if the price suddenly reverses. Conversely, if open interest is increasing while the price is rising, it's a sign that longs are piling on, which could lead to a long squeeze if the price suddenly reverses. Finally, let's talk about the long-short ratio. The current 24-hour long-short ratio is 47.76%/52.24%, which shows a slight bias towards the short side. This tells us that the market is still leaning bearish. However, it's important to note that this ratio can change very quickly. A sudden shift in sentiment could lead to a rapid increase in long positions, which could trigger a short squeeze. So, what does all of this tell us? It tells us that the market is in a state of flux. There's a lot of uncertainty, a lot of fear, and a lot of leverage. This is a dangerous combination, and it's why it's so important to be cautious and to manage your risk carefully. The traders who will succeed in this market are the ones who can read between the lines, who can see the signals that the market is giving them, and who can act decisively when the opportunity arises. Now that we've analyzed the market from every angle, let's talk about strategy. How can you, as a short-term, mid-term, or long-term trader, not just survive in this market, but thrive? Let's break it down. For the short-term trader, the name of the game is risk management. In a choppy, sideways market like this, it's easy to get chopped up by fake-outs. Here's how to avoid that. 1. Tight stop losses are your best friend. I can't stress this enough. In this market, you need to be ruthless with your stop losses. A 1 to 2% stop loss is not unreasonable. The goal is to cut your losses quickly and live to trade another day. 2. Play the range, but don't get greedy. As we discussed, the current range for Bitcoin is between $93,600 and $100,000. It's tempting to try and catch the exact top and bottom of the range, but that's a fool's errand. Instead, look for entries near the edges of the range and take profits in the middle. Don't wait for the price to hit your exact target. Take what the market gives you and get out. 3. Watch the order book and volume. In a sideways market, the order book is your crystal ball. Look for large buy or sell walls, as these can act as short-term support and resistance levels. Also, pay close attention to volume. A breakout on low volume is likely a fake out. A breakout on high volume is a sign that a real move is underway. 4. Stay informed, but don't overreact. Keep an eye on the news, especially any headlines related to the Fed or crypto regulation, but don't let every headline dictate your trades. The market has a tendency to overreact in the short term. Stick to your trading plan and don't let emotions get the best of you. For the midterm trader, the key is to be patient and wait for the trend to reveal itself. Here's your playbook. 1. Identify the trend and trade with it. Right now, the trend is down. That means that the path of least resistance is to the downside. Look for opportunities to short rallies rather than trying to catch a falling knife by going long. 2. Wait for confirmation. Don't try to be a hero and call the exact bottom. Wait for the market to give you a clear signal that the trend is changing. This could be a bullish crossover on the daily MACD, a move out of the oversold territory on the daily stochastic RSI, or a decisive break above a key resistance level, like the 105,000 to 106,000 neckline. 3. Use a combination of technical and fundamental analysis. As a midterm trader, you need to have a more holistic view of the market. Don't just rely on technical indicators. Pay attention to the fundamental drivers of the market, like institutional adoption, regulation, and macroeconomic trends. 4. Have a clear invalidation point. Before you enter a trade, you need to know where you're wrong. If you're going long, what's the level that, if broken, would invalidate your bullish thesis? If you're going short, what's the level that would tell you the trend has reversed? Having a clear invalidation point will help you to manage your risk and avoid large losses. For the long-term investor, the strategy is the simplest, but also the hardest to execute. It's the strategy of doing nothing. Here's how to master it. 1. Zoom out. When the market is in a panic, it's easy to get caught up in the short-term noise. The best thing you can do is to zoom out. Look at the weekly, monthly, and even yearly charts. You'll see that these corrections are a normal and healthy part of a long-term bull market. 2. Dollar cost average, DCA. Instead of trying to time the market, which is a fool's errand, a much better strategy is to dollar cost average. This means investing a fixed amount of money at regular intervals, regardless of the price. This allows you to buy more when the price is low and less when the price is high, which is the essence of smart investing. 3. Focus on the fundamentals. The long-term value of crypto is not determined by the day-to-day price fluctuations, but by the underlying fundamentals. Is the network growing? Is adoption increasing? Is the technology improving? As long as the answers to these questions are yes, then you have nothing to worry about. 4. Have a long-term time horizon. The key to successful long-term investing is to have a long-term time horizon. Don't invest money that you're going to need in the next 6 months or a year. Invest money that you can afford to let sit for 5, 10, or even 20 years. That's how you build real wealth in this market. Thank you for joining me on Boni's Life. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss our next deep dive. And as always, trade smart, trade safe, and I'll see you in the next one.